Welcome to Breaking News to Trading Moves. Today, we're focusing on a stack of information that just came out, looking at some recent corporate results. Our mission here is really to give you a clear, structured view of the facts. We want to analyze who gains and who loses exposure based on what the news is telling us.
Exactly. So you can see how these events might affect related industries and, what it means for different portfolios.
The central event we're going to be analyzing is the latest set of financial results from Disney, that's ticker DIS. And these results were, let's say they were complex.
That's a good word for it. Very complex.
There were some beats, some misses, and a really aggressive strategy for shareholder returns.
Right. And all of this is happening against a backdrop of some ongoing operational friction that we really need to get into.
Okay, so let's start right there with the results themselves.
Mm.
On the earnings side, the story was, well, it was pretty positive.
It was. They beat what the analysts were expecting for profitability. And the two main growth engines everyone's watching, streaming and the parks, they both performed quite strongly.
Which really confirms the company's strategic direction, doesn't it?
It absolutely validates the pivot they've been working on for years now. The park segment, which they call experiences, just keeps showing this robust pricing power.
And high consumer demand.
And high consumer demand. It's a reliable source of cash flow. Meanwhile, the streaming division, which, let's be honest, has been a huge drain on capital for a long time.
A money pit, some would say.
A money pit, yeah. It showed a marked improvement in its economics. They're getting much closer to sustained profitability there.
So that combination, in theory, should really reassure investors about the long-term picture.
In theory, yes. But theory met reality when you look at the top line.
Right, the revenue number. It actually missed expectations, just slightly, but it missed.
And the components that were responsible for that miss are where the market really focused its attention.
You're talking about the deep, persistent weakness in legacy TV. That's all the broadcast and cable channels.
That, combined with a softer performance from the film studio, the movie slate just didn't perform as well as hoped.
So that revenue stagnation, driven by those older segments, that's really the elephant in the room, isn't it?
It is, even with the massive success of the parks, which are running at, peak capacity and pricing, and the improving subscriber numbers on the streaming side.
The decline in legacy TV is just offsetting all that good news.
It's offsetting the momentum. I mean, legacy TV is built on two pillars. You have the affiliate fees that the cable distributors pay.
And then linear advertising revenue.
And linear advertising. And both of those are, they're structurally eroding, so the overall top line stays pretty flat, which masks the success that's happening underneath.
And in response to that flat growth and all the concerns that come with it, management came out with some very specific, very tangible sweeteners for shareholders.
They did. The message from the company was pretty clear. Trust our balance sheet, trust our cash flow, even if the top-line growth looks stalled.
So what did they announce?
Two big moves. First, they increased the dividend payout by 50%, 50.
Wow, that's a classic signal, right?
It's a classic signal of capital maturity. It's a company saying, look, we have excess cash, and we're confident enough in our future earning power to return more of it to you on a permanent basis.
And the second move was the buyback plan.
Yes. They ramped up their share repurchase program in a big way. They're aiming for $7 billion in buybacks by 2026.
$7 billion. That is a deliberate, aggressive move to use cash to reduce the share count.
Which, in turn, boosts earnings per share. It makes the company look more efficient, at least on a per-share basis.
Okay, so here is the paradox we really need to analyze. You have a company that delivers an earnings beat. It shows future-facing growth in key areas.
And it promises $7 billion in buybacks and a 50% dividend hike.
Historically, that combination is rocket fuel for a stock. But it wasn't. The stock sold off.
It did. The market chose to look right past all that cash being returned and focused instead on the operational liabilities.
And that's where I have to wonder, is the market basically saying this buyback plan is just financial engineering, a way to clean up the EPS number while the real fundamental operational problems are left unresolved?
That's a great question, and I think that's exactly what the market is saying. It's because of this the sum of the parts valuation tension.
Okay, break that down for us.
Investors are essentially valuing Disney in pieces. They're assigning a high value to the resilient parts, like parks and experiences, and a growing value to streaming. But
they're assigning a rapidly shrinking, maybe even negative valuation to the legacy media division.
Precisely. The sell-off implies that the perceived liability of managing that declining legacy TV and film business, which is going to require huge restructuring, massive content budget reallocations, is so vast that it overshadows the immediate $7 billion injection.
So the buyback is seen as a temporary financial fix, while the decline of the cable bundle is seen as a permanent structural problem.
You've got it. The liabilities of the past are outweighing the investment in the future, even with the incredible success of the parks division.
Now, beyond that generalized weakness in legacy TV, the market also latched onto a very specific, very public fight that's going on.
The carriage dispute.
The blackout involving YouTube TV.
Yes. And that operational friction is such a critical signal. The dispute with YouTube TV, which is owned by Alphabet, ticker GOOGL, is a highly visible reminder of just how painful this media transition really is.
It's not just about who gets paid, is it?
No, it's about the underlying economics of content distribution just kind of collapsing. The fight really underscores the growing pressure on the traditional pay TV model, even when that model is delivered virtually over the internet.
So, for our listener, explain why they should care about one service, YouTube TV, arguing with one content owner, Disney. What's the broader significance?
Because it represents the end game of the cable bundle. Disney owns what is still considered must-have content, especially sports rights, through ESPN.
Right. They want to get paid the maximum amount in affiliate fees for that content.
Of course. And YouTube TV, like every other distributor out there, is fighting to keep the price palatable for their subscribers. Because if they raise their prices too much, people cancel. They churn.
And every dollar that YouTube TV has to pay Disney for the right to carry its channels comes directly out of their margin.
Or it gets passed directly to the consumer in the form of a higher bill. A public fight like this one validates the market's worst fear.
Which is what?
That content owners and distributors are now locked in a zero-sum battle over a shrinking pie of money. The result is margin pressure for the distributor and, eventually, loss of those carriage fees for the content owner. It's a systemic risk playing out in real time for everyone to see.
So Disney's mixed results create a clear market reaction. Stock goes lower, focus on the structural problems. So let's use this information now to classify the rest of the industry. We'll move into identifying the gainers in the marketplace based on this news.
This is where we take that validated narrative from Disney and we apply it to its peers. The market doesn't trade in isolation. It's all about relative strength and weakness.
Okay, let's begin with our first class of gainers. Diversified media entities that have both parks and streaming assets. This group includes Disney itself, ticker DIS, because its growth engines were validated, and also Comcast, ticker CMCSA.
The core investment rationale here is that diversification acts as insulation. Disney just demonstrated that a robust combination of exceptional parks performance and, measurably improving economics in streaming.
It has the power to offset that sustained weakness in the legacy assets.
It does. It's not just about growth, it's about balance.
So why are parks such a crucial counterweight right now in this environment?
Well, they provide what the media side simply cannot. Highly reliable, inflation-protected, high-margin cash flow.
Explain that a bit.
The park segment benefits from pricing power. People will pay more for a unique physical experience. And they have high fixed cost absorption. Once the cost of building the theme park is sunk, the marginal cost of selling one more ticket or one more $60 sweatshirt
Is incredibly low.
It's incredibly low. So this cash flow stream is largely insulated from the whims of streaming subscriber growth or the decline of cable affiliate fees. It's the lifeline that funds this very expensive transition.
Okay, so if Disney's park segment is that powerful, how does that positive sentiment then carry over to a company like Comcast, ticker CMCSA?
It's a clear, positive read across directly to Comcast. Comcast is the primary peer that has this essential business mix. They operate universal parks and experiences, and just like Disney, that division provides that essential, reliable, high-margin cash flow.
So when Disney's results confirm that consumer demand for premium leisure travel is still strong, it validates the whole strategy for Comcast too.
It absolutely does. And on the streaming side, you have to remember Comcast operates Peacock.
Right, so how does the Disney streaming story, that move toward profitability, benefit Peacock?
Disney's progress validates the idea that even a later entrant to the streaming game can eventually achieve operating leverage and get to profitability. Comcast benefits because its own parks and the continued investment they're making in streaming assets, like the huge Epic Universe expansion that's coming, can help counteract the internal pressure on its core cable and channel businesses.
So the market rewards this balanced approach.
It does, because it recognizes that the decline in linear TV is a structural certainty. It has to be mitigated by non-media revenue streams.
Okay, let's pivot now to our second class of gainers,
Yeah.
scaled streaming platforms. This category is focused on the big global platforms, specifically Netflix, ticker NFLX, and Warner Bros. Discovery, ticker WBD.
The foundational thesis here is all about the maturity of the streaming model itself. Disney's results confirmed they had strong subscriber growth, and it also gave hard evidence of improved profit margins in their direct-to-consumer division.
And this confirms a broader industry idea, right?
Hmm.
That the streaming wars are moving past that initial unsustainable phase.
Exactly. We're moving out of the spend at all costs to get subscribers phase and into the discipline we need to make a profit phase.
Can you elaborate on that core lesson?
Mhm.
When you say scaled streaming can evolve into a stable, reliable, cash-generating enterprise, what does that actually mean mechanically?
It all boils down to operating leverage. Content creation is a massive fixed cost. Whether Disney spends, say, $5 billion or $10 billion developing a year's worth of shows and movies, that cost is fixed.
Okay.
Once they reach a critical mass of global subscribers, the marginal cost of adding one more subscriber who pays the full monthly fee is essentially zero.
Right, because the content is already paid for.
The content is already paid for.
Oh.
This means that after they cover their initial content spending, every new dollar of subscription revenue drops straight to the bottom line as profit. Disney's reported margin improvement suggests they have finally hit that inflection point where operating leverage really kicks in and the cash drain stops.
That's a powerful endorsement for the entire sector. So how does that translate specifically to Netflix, NFLX, and Warner Bros. Discovery, WBD?
For Netflix, ticker NFLX, the benefit is immediate validation. They are the clear market leader. And if the laggard, in this case Disney, is confirming the economics of scale, it only reinforces how robust Netflix's own model is.
It justifies their high valuation and their push into new revenue streams.
Exactly. Things like advertising and cracking down on password sharing, those moves just further accelerate that operating leverage.
Now, I have to challenge you a little bit on including Warner Bros., Discovery, ticker WBD, in this group. While they do have the Max streaming service, they're also weighed down by a massive amount of debt from the merger.
That's a fair point.
And they're still working through a lot of integration issues. Doesn't Disney's success just highlight how far behind WBD might be in achieving that same profitable scale?
It's a very fair point, and it absolutely reflects the tension in how the market views WBD right now. However, the reason they gained some positive sentiment here is due to the principle of scale. Okay. Investors are now prioritizing who can reliably convert massive streaming investment, which WBD has certainly made, into sustained earnings. Disney's performance provides critical proof of concept for the whole cohort. It tells investors that the eventual destination for Max is profitable scale if.
A big if.
A very big if. If WBD can successfully manage its high leverage and its content strategy, it raises the probability of success for all the major players with that global reach. The market views this as a rising tide for platforms that are already at the required scale.
Understood. So the market is pricing in the potential for that leverage, regardless of the current balance sheet problems. Let's move to our third class of gainers, companies that are tied to leisure and cruise exposure. We're coming back to Disney, DIS here, and also including Royal Caribbean, ticker RCL.
This category is focused purely on macro consumer behavior. The robust performance that we saw in Disney's parks and its cruise operations points toward an enduring consumer demand for premium travel and high-end experiences.
And this is a crucial read on the current economic environment, isn't it?
It is. We're seeing evidence that consumers are still prioritizing experiences, even if they might be pulling back on other types of spending.
So discretionary spending is flowing more into memorable experiences rather than, say, physical goods or lower-end services.
Precisely. And Disney's experiences segment, which includes the theme parks, the resorts, and the Disney Cruise Line, is positioned directly at the premium end of this demand curve. They're seeing strong forward bookings, and they're maintaining high pricing power, which suggests this trend has some longevity.
So how does that connect to the financial outlook for a company like Royal Caribbean, ticker RCLF?
This positive backdrop acts as an immediate endorsement for any entity with direct exposure to cruises and high-end leisure spending. Cruise lines are, essentially just floating premium resorts.
So when Disney, which operates its own high-end cruise line, reports resilience and strong bookings, it confirms a healthy operating environment for the entire cruise sector.
Exactly. Royal Caribbean, RCL, benefits because Disney validates the willingness of the consumer to spend large sums of money on non-essential, long-term scheduled trips.
And Royal Caribbean is a pure play in this sector.
They are. The strength we observed in Disney's experiences segment reinforces investor confidence in Royal Caribbean's ability to maintain high occupancy rates and, critically, to maintain and even increase their onboard spend figures.
Which is the money guests spend once they're actually on the ship.
Right, which is highly, highly profitable. They gain sentiment as the market recognizes the strength of this whole experience economy, especially against the backdrop of all the chaos in the media transition.
So to summarize the gainers, it seems the market is choosing companies that are insulated by that reliable leisure cash flow, or those who have proven they can achieve profitable scale in streaming.
That's the perfect framing. These are the assets that have a hedge against the digital upheaval. Now, we have to turn the ledger to the flip side.
The names whose business models are exposed by the very problems that Disney's report highlighted.
Let's get into it.
We'll start with our first group facing pressure. Virtual pay TV and distributors. This includes Alphabet, ticker GOOGL, which runs YouTube TV, and also Charter, ticker CHTR, one of the largest traditional cable operators.
The pressure here stems directly from that operational friction we talked about earlier. That public, contentious Disney blackout on YouTube TV serves as a clear illustration of how delicate the virtual pay TV model has become.
Especially when content costs are inflating and these carriage fights erupt.
Exactly.
Let's delve a bit deeper into the economics of virtual pay TV, the so-called skinny bundle. Why is it inherently so fragile when it faces these content disputes?
It's fundamentally a high-volume, low-margin business model. Virtual distributors rely on aggregating popular content, especially live sports and local news, to attract subscribers. They need that content to be cheaper than the traditional cable bundle to justify their existence.
But the content owners, who are facing their own declining linear revenue, are desperate to maximize the affiliate fees they charge distributors.
It's a collision course. The content owners need to charge more per subscriber to make up for having fewer subscribers overall.
And this puts a company like Alphabet, GOOGL, in a very difficult position with YouTube TV. What are their specific pressure points?
GOOGL faces pressure on multiple fronts. First, there's margin risk. If they just absorb the content cost increases without raising prices for their subscribers, their already thin margins get even smaller.
And then there's churn risk.
There's churn risk. If they do raise prices to pass on those costs, subscribers who are already very sensitive to price creep will just cancel the service. That highly publicized dispute over ESPN rights puts their must-have content and therefore their entire subscriber base at risk.
And strategically, YouTube TV is a play for Alphabet to control more of the consumer's entertainment behavior, right?
It is, and service interruptions and blackouts completely undermine that strategic goal. It erodes trust.
So how does this same pressure apply to a traditional cable operator like Charter, ticker CHTR, even though they aren't a virtual provider?
Charter faces an identical financial risk, but it's amplified by their legacy infrastructure. Just like GOOGL, Charter is locked in constant brutal negotiations with content owners over rights. The visibility of the Disney YouTube TV fight just validates the extreme bargaining power that content owners still wield.
So every price increase Charter has to absorb or pass on puts more pressure on their core cable video business.
It accelerates cord cutting, which is the secular trend they are desperately trying to slow down. The margin squeeze, having to pay more for content that fewer people want to watch in the old format, is relentless for all distributors, whether they're virtual or traditional.
Okay, let's look at our second class under pressure. The linear TV-heavy media companies. The names here are Paramount Global, ticker PARA, and Fox, ticker FOX.
This is really a matter of disproportionate exposure vulnerability. Disney's report confirmed the deep, continued decline in traditional television operations across the board.
So it reinforces that undeniable long-term downtrend affecting affiliate fees and advertising revenue for linear channels everywhere.
It does. And the reason Disney's legacy weakness translates into a negative outlook specifically for Paramount and Fox
is because their business mix is just more exposed.
Exactly. Those two companies maintain a proportionally larger exposure to these older broadcast and cable networks, and they simply lack the necessary balancing assets.
Meaning they don't have a parks division.
They don't have a parks division to act as that powerful hedge against the decline. Paramount Global relies heavily on its cable portfolio brands like Comedy Central, MTV, and its broadcast network, CBS. Fox is heavily concentrated in cable news and sports broadcasting.
So their revenue mix makes them inherently more vulnerable to the structural changes that even a giant like Disney is barely managing to contain with its non-media assets.
Precisely. If Disney, with its massive content library, its global scale, and its theme park cash flow, is struggling to just maintain flat revenue because of that linear decline.
The outlook for less diversified companies is significantly harsher.
It is, and the vulnerability is twofold. First, viewership is migrating to on-demand digital platforms, which shrinks the audience for linear advertising. Second, the pricing power of those affiliate fees is weakening rapidly as cable bundles shrink and consumers actively downgrade their packages.
And the migration of advertising dollars is a brutal headwind here, isn't it?
It's existential. Traditional linear TV advertising, which is a major, reliable revenue stream for both PARA and FOX, is just becoming less and less efficient compared to the targeted digital advertising platforms run by companies like Alphabet or Meta.
Advertisers are just chasing the eyeballs.
They're chasing the eyeballs, and the eyeballs are moving. So the structural decline in affiliate fees, coupled with that drain of ad dollars, creates a continuous revenue headwind that is incredibly difficult for PARA and FOX to overcome without a dominant cash-generating streaming platform to pick up the slack.
And their attempt to transition to streaming is hampered.
It's hampered by the fact that the legacy cash cow is dying faster than the new platform can grow to replace it.
Finally, we have to consider our third category, the cinema chains reliant on big studio slates. The names here are AMC Entertainment, ticker AMC, and Cinemark, ticker CNK.
This classification really reveals the extreme structural dependency that theatrical exhibitors have on a very small number of content creators.
Right. The weak performance we saw from Disney's recent film slate, which has some high-profile underperformers, serves as a powerful reminder of this.
It's a reminder that theater operators are heavily reliant on the consistency and the sheer quality of the releases from the major studios. They are the definition of a passive distribution channel.
So the exhibitor is essentially held hostage by the creative output of a handful of content studios.
Absolutely. They control the real estate, the theater itself, the distribution mechanism, but they do not control the product quality, the marketing budget, or the release timing.
So when a content titan like Disney, DIS, has a softer year at the box office, that impact doesn't just stay within Disney's film division.
No, it immediately flows downstream to theatrical exhibitors all over the globe.
How exactly does that impact hit the balance sheets of chains like AMC and Cinemark, CNK?
Well, it hits them where it hurts the most. High-margin concession sales and fixed costs.
Okay.
Theater chains operate with extremely high fixed costs, rent, electricity, labor, that have to be paid regardless of how many people show up. Their profit is made predominantly on concessions.
Popcorn and soda.
Popcorn and soda, which can have margins of 80% or even more. So if Disney's slate is weak, overall attendance drops. Lower attendance means fewer tickets sold, but critically, it means far fewer sodas and tubs of popcorn being sold.
So a weak slate compromises their highest margin business.
It does. Furthermore, a weak slate reduces the theater chain's overall pricing power. They can't aggressively push up ticket prices or charge premium upcharges for different formats if the content itself isn't driving buzz and demand.
So the market looks at a miss from Disney, a major source of guaranteed revenue, and immediately downgrades the revenue expectations for the entire exhibition space.
Immediately. Chains like AMC and Cinemark are financially fragile, and any volatility in the content pipeline due to studio underperformance puts immediate pressure on their operating margins.
This entire classification exercise really has crystallized the structural division in the media world today, hasn't it?
It really has. On one side, you have the businesses that are leveraging future consumer habits, things like streaming scale and premium leisure experiences. And on the other side, you have those grappling with legacy infrastructure challenges.
Whether that's the declining affiliate fee model or the dependency on unpredictable movie slates.
Exactly. The market is executing a ruthless sorting process. It's valuing assets based on their proximity to stable growth or their distance from structural decline. The winners are those using high-quality cash flow from resilient businesses, like the parks, to fund the necessary transition to streaming scale.
And the names under pressure are those caught squarely in the crossfire of declining distribution and continuous content cost inflation without a reliable hedge to protect them.
That's it in a nutshell.
That brings us to the summary of our analysis. To recap the main lessons for you, we looked at how the successful execution in parks and the scaling of streaming are driving shareholder confidence. This is benefiting Disney, ticker DIS itself, and its diversified media peer Comcast, CMCSA, as well as the pure-play cruise operator Royal Caribbean, RCL.
And furthermore, the market validation of profitable streaming scale provides essential support to Netflix, ticker NFLX, and even Warner Bros. Discovery, ticker WBDD.
Conversely, the structural weaknesses that were exposed in linear TV and in the volatile content distribution models are creating clear headwinds for others.
This includes distributors facing severe margin pressure, like Alphabet, ticker GOOGL, through its YouTube TV service, and the traditional cable operator charter, CHTR.
It also includes the linear TV-heavy companies, Paramount Global, PARA, and Fox FOX, which just lack adequate diversification.
And of course, the highly dependent exhibition chains, AMC, ticker AMMC, and Cinemark, ticker CNK.
A final thought for you to consider as you process this information. Track the tension between the enduring strength of the experiences economy and the accelerating contraction of traditional media.
Specifically, how long can the strong demand for premium leisure travel, as we see from Disney and Royal Caribbean, sustain these massive media conglomerates while their foundational TV models are being actively dismantled by streaming economics? That's a crucial dynamic worth tracking as we move forward.
A compelling dynamic indeed. Thank you for joining us on this exploration of market classification following the latest corporate news. A reminder that this discussion is purely the opinion of the author and is based entirely on the documents reviewed. This is not financial advice or a recommendation to buy or sell any of the securities mentioned. DIS, CMCSA, NFLX, WBDRCL, GOOGL, CHTR, PARA, FOXANC. Thank you for taking this journey with us.